Index funds and ETFs are those basic tools in the investment toolkit that are simple and effective to use, as they can efficiently deliver diversified, low-cost portfolios for any budget. While both perform a very similar function, there are differences that impact you as an investor. This video takes a look at these two indispensable tools and what they mean for your portfolio. Hi there, welcome to my channel, where we talk money and having more of it. Let's talk index funds and ETFs. Index fund, as the name suggests, are any funds that function as a miniature copy of an established market index, such as the S&P 500 in the US or the FTSE 100 in the UK. If an index fund invests in the FTSE 100, for example, that fund will contain shares of every single company on that market and will track the performance of that market. When you buy an index fund, you are buying a slice of the entire market. A good way to think of an index fund and even an ETF is to imagine a basket that contains stocks and bonds and a wide variety of other financial assets that we would want to invest in. Index funds tend to be passively managed, and this means rather than being managed by a human fund manager who often requires things like a big salary, they are programmed with an algorithm that simply tracks that entire economic sector or index, like the FTSE 100. Both the passive index fund and the ETF want to match the performance of their reference market, as opposed to outperforming that market as that expensive fund manager tries to do in an actively managed fund. ETF stands for Exchange Traded Fund and refers to an investment fund that lets you buy a large basket of individual stocks or bonds in one purchase. Very similar to an index fund, right? But ETFs, although very similar to an index fund, do have differences, and this can impact your portfolio. So let's take a look at the differences. The first difference is their structure. Most index funds are set up as OICs in the UK. This is an open-ended investment company, and it's basically a regulatory structure in the UK for pooling investors' funds, purchasing assets, and issuing shares to those investors. Index funds can also be set up as unit trusts, and they will issue units. The equivalent of the index fund in the US is the mutual fund. OICs and unit trusts are called open-ended vehicles because the number of shares and units in these funds is unlimited. They can issue more shares and units as more people join the fund, and they can cancel shares and units as people exit the fund. ETF shares are listed on the stock exchange. In the UK, they are listed on the London Stock Exchange, and they trade like ordinary shares. They are also open-ended and can also create and cancel shares as investors buy into the fund or exit the fund. The second difference is the assets in the vehicle. Our index funds are tied to a specific market, and they're simply tracking the performance of that specific market and all the companies in that market. ETFs, on the other hand, can bundle together a wide variety of assets. They can include gold or renewable energy, real estate, and even industries and international markets. So, for example, if you wanted exposure to renewable energy, but you were invested in an index fund tracking the FTSE 250, you will have exposure to every one of those companies in the FTSE 250 and not just the renewable energy companies that you were attempting to put into your portfolio. And this would mean that you're investing outside of possibly your investing plan or your investment values. ETFs don't always necessarily hold the securities of the index they track. Physical ETFs do, and they may either buy every one of the shares in that index, or they may buy a representative sample of the shares in that index. There are ETFs, however, that don't hold the physical assets within their index, and these are termed synthetic ETFs. And what they attempt to do is to create a pretend portfolio that attempts to match the index that they're trying to track without physically holding their assets in the index. And the way they do this is with complex financial instruments which are bought from financial institutions. And what this means is that the investor in one of these ETFs is not only exposed to the performance of the assets in the ETF, but also to the counterparty, the financial institution or financial institutions, if there are many of them. And that means if that financial institution or financial institutions go bust, the investor can lose their money. In ETFs that are regulated by the UCITS guidelines can only invest 10% of their net asset value with one financial counterparty, which does to some extent mitigate against this counterparty risk. But if you wanted to avoid the counterparty risk, it's much easier to do it by simply sticking to ETFs that physically hold the assets that in the index that they are attempting to replicate. Just on that note, as a small little sidebar, what is a UCITS fund? So basically, UCITS stands for the Undertakings for Collective Investment in Transferable Securities, and it's a regulatory framework of the European Commission in which they attempted to create a standardized structure and investor protections within these funds. And this is in order to be able to make them trade freely across Europe and internationally. So if you were to buy a UCITS fund from Europe in the US, you would know the standardized structural terms and the investor protections. Now let's move on to difference number 3. The third difference is the pricing of the vehicle. The open-ended structure of an OEIC means its price reflects the underlying value of its assets, and rather than the supply and demand factor related to the fund shares itself. If the fund's underlying assets increase in value, the price of the fund's share will increase in value. If the underlying assets value decreases, the price of the share of the fund will decrease. The price is calculated once per day according to a formula set out by the Financial Conduct Authority in the UK. And this basically standardizes how the fund calculates its net asset value. But because the calculation only takes place once per day, this means that you may probably want to trade throughout the day. You're not going to know the exact price at the time you buy or sell shares in the fund. And this will only be known when the fund does its calculation again for that day of its net asset value, and this is typically at 12 p.m. Now this is extremely odd, but you have an equal opportunity of getting in or out of the fund at the high price or getting in or out of the fund at the low price. And if you are a long-term investor, over the lifetime of your investment, this will be pretty immaterial. Now, the ability of ETFs on the stock exchange to trade all the time means that their share price does not necessarily always exactly match the underlying value of the assets in that fund, and it is somewhat subject to the demand and supply of the shares in that fund. But over time or over the day, that difference between the share price and its asset values will be so insignificant that, again, if you are a long-term investor, this is pretty much irrelevant for you. Let's now move on to difference number 4. The fourth difference is the costs of each. Advantage of index funds over ETFs is that you won't pay broker commission if you choose a broker that doesn't levy dealing charges on funds, and most don't. And this makes index funds ideally suited to small investors who want to make a small regular contribution over time. Broker's commission is the big additional cost attached to ETFs, and small investors need to be aware of this. Online brokers in the UK charge around £10 per transaction, and this is disastrous if you want to contribute a small amount into your ETF each month. Consider if you wanted to contribute £25, £10 of that is just going to be for charges. So dealing costs can mean that ETFs are totally unsuitable for drip feeding when you are adding a small amount into your fund every month. And the way around this is for small investors to first accumulate a large lump sum and then invest it. But this totally negates dollar cost averaging. And dollar cost averaging is where you regularly contribute amount every single month, and over time the cost of your investment evens out. So if you get in at a high price one month and a low price the next month, it averages out to a reasonable cost over the time of your investment. So if you can't dollar cost average, you're missing out on that averaging effect. Now, both ETFs and index funds are subject to an ongoing charge figure, which is also known as a total expense ratio. And the ongoing charge figure is made up of the fund's costs of marketing, of regulation, and of administration. And it's meant to be calculated on a standardized approach so that you can compare the OCF across various funds and decide which is the most efficient for you. OCF charges on passive index funds and ETFs is generally between 0.07% to 1%. So based on all of that, which do you choose? Well, index funds offer a lot fewer choices than ETFs, but they are simpler to understand, to use, and to manage. And there are fewer costs involved, which means that they're very attractive from a drip feeding perspective and make it easy to rebalance your portfolio. ETFs are a fairly young product. They first appeared in 1993, and while they took off and have been very popular in the US, it's only in the last few years that they've become popular in the UK. And since they started where they were these vanilla index type tracker funds, they've now morphed into more complicated structures and include complex financial instruments. That being said, ETFs are unmatched for choice and offer a huge degree of diversity, and passive investors can mix and match their ETFs with their index funds to create the ideal portfolio. And on that note, if you're ready to get started investing, pop to the comments below and grab the Investing 101 guide. If you like this video, please let me know by liking it, share it with other ladies who are ready to change their financial story, and comment below if you found anything useful or helpful. For financial education and money talk designed for women, please subscribe to my channel and hit the bell to be notified when I post a new video. It's been great speaking to you.